Well, welcome everyone to today's InvestSMART webinar with Alastair, Davidson and myself. And we're talking about investing for retirement. This webinar is to support a ebook that was published last week by InvestSMART about investing for retirement and is available on the InvestSMART website. And you probably got a, if you're a subscriber or member of the InvestSMART family, you would have got an email with an attachment of the ebook. And this webinar is to provide you with some background on that, and also the opportunity to ask questions. Because after Alastair's given us a bit of a presentation, you can ask some questions, which I will put to Alastair, and he will answer them. So I think that's great. We're looking forward to it. And now over to Alastair.
There you go. Thank you, Alan. And welcome, everybody. So I've prepared a little presentation here. Let me just make sure I can get this up. As Alan mentioned, this is a sort of summary of the ebook plus some additional material about, what you should do when you're investing for your retirement. And just to give you a snapshot of what we're going to talk about, just how much do you need to retire? That's always a big $64,000 question. Can you ever have enough? Obviously, it's better to have more money. Sorry, Alex.
No, you can't have enough. You always want more, but anyway.
Certainly my wife thinks that way. And then there's different ways you can hold your retirement wealth. And then how do you generate income from the retirement savings you've got? What's the easy ways, and what should you think about when you're doing this? So just to move on. So I just thought I'd give a little snapshot to everyone of Australia's retirement system and why it's relatively unique in the world. There's a huge quantum of money that's been saved for our retirement. $4.1 trillion. It's difficult to imagine what a trillion is, but as somebody tried to explain to me, if you think of, how many minutes there's been since the last ice age, that would probably be in the trillions of minutes. But how much is in large super funds versus self-managed super funds? And the interesting one is, we are the fifth largest retirement savings pool in the world. And for a country as small with a smallish population like Australia, that's quite an achievement. But why do we have a large savings pot? I picked up this chart the other day from one of the UK newspapers, and it was dealing with the problems in France. And as some of you may know, France has a very generous retirement system where the average retirement income for a pensioner is actually higher than the average wage of a worker. So you get paid more in retirement than you do when you're working, which is not necessarily a sustainable system. But on this chart, Australia sits up, is very much an outlier down at the bottom. And the reason for that is the government has spent the last 36 years encouraging us and giving us tax incentives to save for our own retirement, with a counter that they're not going to pay us very much if we haven't saved. So that's why we have a large savings pot, and that's what the government has encouraged us to do for the last 30 odd years, that you have to save for your own retirement, because if you don't have enough, you will not get a great income from a state pension. So the government's done a great job. They've encouraged us all to do this. What that does raise, though, is some other issues, which we'll touch on later on. So how much do you need to retire? I mean, the easy questions are, how old do you want to be when you retire? You can retire, obviously, anytime after 60 and start drawing money out of your pension pot. Obviously, the later you retire, the longer you work, the less you might need, and the shorter period that you will have to create an income for yourself. The other point, how much do you intend to spend in retirement? I mean, if you're obviously planning to go on luxury cruises around the world every year for 6 months of the year, you'll need a lot more money than if you intend to stay at home and potter around the garden and not spend too much money on lavish items. And then the other critical one, which we'll touch on again, is how long do how long do you think you'll live? I mean, obviously, all of us want to try and live for as long as possible, but if you get to a certain age, your lifespan is relatively long, so you do have to think about that. And then the last point, which we'll touch on, which is probably the most important point: how much can you earn on the savings pot that you've got? You can have a pot of $1 million if you can earn 10 or 15% on it. That's a great outcome. But if to get the same income, you might need $2 million if you're only earning 5%. So how do you maximize the earnings you make on your savings without taking too much risk? And then obviously the next point is, which we'll touch on later on, is where do you keep your retirement savings? You can put them in a public offer super fund. You can keep them in a self-managed super fund, of which 30% of the assets are in there. Or you can keep it outside of super. And the reason we touch on the outside of super is, there are tax advantages for keeping money inside your super funds, but it does limit the flexibility you have as to how you might spend that money and what access you have to it. So you do have to think about, do you want to put all your money into super? And then a self-managed super fund. So just touching on self-managed super funds, you probably need about $250,000 to make them cost efficient. Self-managed super fund, one of the big benefits is it gives you a fair amount of control over what you want to invest in. And it also offers you some flexibility in estate planning. You can, to some extent, pass on some of your superannuation balances to your children, not without tax, but there's some benefits in how you pass it on. And at the moment, there's no inheritance taxes within Australia, so there's no impost on passing money on to your children. And also, you can withdraw money in lump sums after a certain age, after 65, and pass on certain amounts of money to your children on that basis. The downsides to self-managed super funds: there are extra costs in running a self-managed super fund. You do have to have an audit. You do need an administrator. There's certain other, the ATO tax office has a levy on super funds to help manage their supervision process. The one that most people forget is it takes a little bit of time to do it. You can't just sort of set up a self-managed super fund and then ignore it and go and play golf all day. You do have to spend a little bit of time doing some of the paperwork. You do need to think about your investments and whether you've got the right investment strategy. You can outsource that to an advisor if you want to. You can use a tax agent to help you do a lot of stuff, but those do add to the costs. But at some point, you do have to spend some time thinking about your self-managed super fund, because you are required to fill in certain documents and update certain documents every year. So you can't just ignore it. Whereas with a public offer super fund, they tend to do everything for you. And you can sort of set up your income streams. You can set up everything with relatively little time and effort on your part. And how can a super fund provide retirement income? Well, there's two ways. I mean, you can get a transition to retirement. You set up a transition to retirement account if you're over 60. So the government does set up this process. Once you're over a certain age, that you can start withdrawing money over 60. It's tax-free, and it's designed so you can sort of move yourself into retirement slowly. If you can take a small amount of money out of your pension fund as a regular income, you can perhaps go to part-time working. The other one that a lot of people forget about is you can go to an allocated pension. And an allocated pension provides effectively tax-free income. So if you think about how you've accumulated money in your super fund, it's typically taxed at 10 to 15% on any income or capital gains. So 15% on income, 10 to 15% on capital gains. Once you move to an allocated pension, it's all tax-free. So if you've got Commonwealth Bank shares in there that you've held for the last 20 years and there's a huge capital gain, once you move them to an allocated pension portion, you can then sell some of your Commonwealth Bank shares without triggering any capital gain. There's no tax to pay. So there's a 10% tax saving if you've held those shares for a number of years. Any income you earn, like dividends on Commonwealth Bank shares or BHP, they are tax-free in your hands, and you get a cash rebate for the franking credits. So it's a very generous system if you moved from your retirement accumulation process to an allocated pension process. There is a limit to how much money you can put into that process, but there is a lot of statistics to say that the majority of Australians stay in accumulated pension schemes for longer than they have to, and they should consider moving to an allocated pension just to get those tax benefits. And the third way you can sort of guarantee yourself an income out of your super fund is to buy an annuity. Now, for those people that don't quite understand how annuities work, they are becoming more common. So typically what happens, you give a lump sum to a life insurance company, in the case whether it's Challenger or AMP, and what they do is they will give you back a fixed annual payment for a number of years. So if you buy, and the numbers typically work out to be, you get about 5 to 6% back per annum. So you put in $100,000 and over 15 years, you'll get $6,000 back as a fixed payment. You can buy annuities that are inflation linked. Obviously you get smaller amounts, but they do move up and down with inflation, so they can grow over time. And certainly Challenger and the AMP also offer lifetime annuities. So they will pay you an annuity until the day you die. What that gives you is certainly it gives you a certain amount of certainty as to how much you'll get and how long you will get that for. So there's obviously benefits. What the downside of annuity is, obviously those payments are relatively small versus what you could earn if you had invested your assets into something else, whether shares or bonds or other investments. So what are the important issues when you're thinking about how you're investing for your retirement? First one is, how long do you need the money to last? So the fear of running out, or FORO as it's called. What you need to do is to make sure you haven't run out of money in your early 90s and you're still relatively fit and healthy, and you have to move to the state pension, because the state pension, as we mentioned earlier, is not particularly generous in this country. Secondly, you've got to look at, well, how much can you earn on your investments? Again, it depends on what you invest in and how much risk you want to take. If you look at the equity markets, typically generate more income and more capital gain than, say, fixed interest markets or property over the longer term. But, it's, if you wanted to buy an annuity, as I mentioned earlier, you'll get a relatively low but guaranteed income. If you want to take some more risk, you can obviously generate more income, but there is a risk that your capital may change. And then the third point there, which is probably the major point, is what effect will inflation have? So, over a period of, let's assume inflation, it was at 7% a few years ago. Let's say it stays at 7%. That means every 10 years prices double. And if you're on a fixed income from your investments, that means your spending power is halved. So you do have to think about how inflation might affect your spending power over the long term. And we're talking, 25 to 30 years. So, what will happen? How much would you have to spend in 30 years' time to buy a cup of coffee? It's $4 today. It could be $10 in 30 years' time. That's probably not the major one to think about. It's more, what will healthcare cost and aged care cost in 30 years' time? Because that certainly has been rising at a rate higher than the CPI, than the average inflation rate, and is probably likely to continue. So you need to make sure you have some process in your investments where your income is going to grow at least by inflation. And then the last point is, as I mentioned, how could your retirement change if market moves? So in other words, equity markets go up and down, fixed interest markets move. It's what the market, or what people in the retirement industry call the sequencing risk. So I'll touch on that slightly later, because it's a fairly important issue, and it's not one that's got an easy solution. But you do have to think about, if you've got a lot of money invested in equities, and equities values drop by 25%, how does that affect your income from your investments? So just to touch on the first point, how long do you need to make your income last for? So an Australian born today, will live to an average age. This is an average age, not a median. 81.1 for a man, 85 for a woman. What's probably more important to look at is if you're age 65, how long will you live? So a 65-year-old man, so he's not been killed in a car accident or died of some other tragic accident. Your average lifespan is actually longer. So 85 for a man and 87 for a year. Now, the last point, which I want to stress, is these are averages. So that probably means that there's a 50% chance you're going to live longer than that. And that is why we sort of recommend that people look at, for a man, living till they're 90, and for a woman till they're probably 91, 92. That's when you'll need an income. So retiring at 65, you need at least 26 to 30 years of investment income to be covering a likely death level for people over the age of 65. So that's the sort of targeted number of years that we sort of look at. How much can you earn? That's another one that, again, as I mentioned earlier, it depends what you invest in. Obviously, equities can produce probably the highest income. Property can produce a relatively steady and to some extent inflation-linked incomes. Fixed interest, it is what it is. It's fixed interest. It doesn't tend to change very much. If you buy bonds when yields are high, you tend to have a better return than if you buy them when bonds are low. And then again, there's annuities, which give you a fixed return over a certain number of years, but it tends to be fixed. What the US research we've looked at tells you, you want about 60% of your retirement income should come from your investment returns. So in other words, it's when you've saved up all your money, you've probably got 10% has come from your salary, 30% has come from your savings. You've then got to say, well, how your savings have accumulated over the years. That other balance has to come from your retirement income. So what you earn on your investments, is a critical component of what you have to live on. So, and as I mentioned earlier, if you assume you're going to live for at least 30 more years after you retire, you do need to invest in some growth assets, largely to counter the effects of inflation, but also because, you do want to, as you draw down from your capital, you do want it to replenish itself because the assets are growing in value. So you need some portion in that. Inflation, as I mentioned, inflation is a fact of life. It's always going to be there. Inflation, it's always a positive number. I don't think it's been a negative number in my lifetime, and I don't think it ever will be again. As I said, as you retire, your spending patterns change, and the things that you spend money on probably have a higher inflation rate than other staples that you might need, like food and housing. Healthcare costs go up largely because the cost of providing it and the facilities and the technology that's required costs more and more. And certainly insurance costs have gone up in recent years. Whether that continues, who knows, but health insurance for a senior is certainly a growing expense. And also you do need to invest money in growth assets, as I made, just to maintain your spending power. So that's how inflation will affect it. Now, this is probably one of the more important issues. When you start your retirement is actually a critical time. This is unfortunately one of those issues. I know, Alan, you and I have talked about this with Paul Clitheroe and others. Timing the market is one of the hardest things to do, and we generally recommend people don't do it. Unfortunately, when you're in retirement, market timing does become important. This is the one stage in your life when investing at the right time and making sure you're in the right assets at the right time is much more critical. There is no easy way or no easy answer as to how you do that. But we do say you do have to be more cognizant. You want to be in defensive assets when markets are looking bad, and you want to move back to growth assets so you can beat inflation when markets are looking better. And I want to illustrate that with the next slide. So this is a picture. This is assuming that you had $1 million when you retired, and you started your retirement in 2008, and you're withdrawing $50,000 a year. So after 30 years, you'll end, sorry, it's 20, sorry, this is 20 years, I beg your pardon, it's 20 years. After 20 years, if you started in 2008, you would end up with $1 million balance, which you think, well, that's all right. I mean, it's not too bad. If you had started the same process a year later, so in 2009, so you're starting at the bottom of the market, you're now investing in equities, your outcome is substantially different. You're almost $2 million better off. And that's largely because you're buying equities. And this is assuming you're 100% invested in Australian equities. This is the ASX 200 accumulation index. You've only got Australian equities. This would be the difference. Now, this is an extreme example of how market timing can affect you. So what we do say is make sure you have a balanced portfolio, and you want to be balanced between defensive and growth assets, and shift that balance over time, depending on how markets are, but also depending on where you are in your retirement life cycle. And we will touch on this topic again and again. I'm planning to write, I don't know, Alan, if you've read some of my diaries of a self-funded retiree. I have another one coming up, which will touch on this topic.
I can't wait.
I know you're an avid reader, Alan. Thanks.
I am, indeed.
And this is really designed to this is a critical issue. And as I said earlier, there's no easy answer. I mean, I've been in the markets 35, nearly 40 years. I have met very few people who are good at timing markets. So it's
the problem. The basic problem is that when market's expensive, when the market looks expensive, and everyone tells you it's expensive, that's the time to to not be there. But the trouble is that markets, when they're expensive, can get more expensive.
As we're looking at right now, Alan.
That's right. So at the start of this year, I would have said the markets look expensive, but then they've got more expensive.
They've got more expensive. So they really. So I think, as Alan and I both agree, this is a very difficult issue. We'll try and help with some more detailed tips in one of my future diary entries. What can you do? You can make sure you're in a balanced portfolio. And, you don't want to be 100% equities. You don't want to be 100% fixed interest. And it's just how you move that balance from 60-40 to 70-30 to 70-30, 70% defensive to 30% growth, from 70% growth to 30% defensive. That, how would you move that? The only other thing you can do, which we do encourage people to think about, and certainly what I think about, is this assumes an annual drawing of $50,000 a year, no matter what the market conditions are. If you can provide flexibility in how much you spend money, so you can turn off some things you spend money on and turn them back on again, depending on how markets are, it is sometimes much easier to adjust your spending to fit market conditions rather than try to adjust your portfolio to fit market conditions. But it's food for thought. As I mentioned, there is no easy answer. But it is one of the big issues which all Australians are facing, because we all have the same issue, that we have a savings pot, which the government in their foresight has encouraged us to create. What they haven't done is try to solve this issue about what do we invest in to make sure it lasts for as long as it can without us having to adjust our lifestyles too many times. Are there any tax advantages in retirement? Yes, there's obviously, you can purchase annuities with your super money after the age of 60, and they give you a tax-free income. Again, it's similar to a transition to retirement pension. Earnings on assets, as I mentioned, in pension phase are tax-free. Obviously, there's a cap, $2 million, on how much you can put into that pension phase without without triggering any extra tax. And that's, earnings, capital gains, realized capital gains, and income that you earn on those $2 million of assets are all tax-free. Earnings in your accumulation phase are still only taxed at a maximum of 15%. As I said, if you hold assets for more than 12 months in your super fund, they're only taxed at 10% on any realized capital gains. So it's still very beneficial to keep assets within your superannuation system, either in a public offer fund or in a self-managed super fund. And then the last one, which has not yet become legislation, but will probably, there seems to be, a little bit of seems to be very little doubt that it won't happen. This Division 296 tax, this is where the government's proposing to have an extra 15% tax on earnings on balances above $3 million per person. Now, what that means is, if you've got, say, $4 million in your super fund, on the $1 million balance, they're going to start taxing you at 30% on your income and potentially on unrealized gains. That's just apparently still up for debate because it's relatively complicated to actually calculate that. But that is still probably better than keeping assets in your own name and having to pay 40 or 45% tax on income and realized gains. So there's still advantages in maintaining assets in a super fund. Obviously, above $3 million, the government is trying to discourage you from keeping too many assets in your super fund or withdraw assets from your super fund, because part of their issue is, which I sort of agree with, is it's designed to provide an income in your retirement. It's not designed as a tax shelter for all the assets you might have. So I can understand why the government's looking to do something. Whether this is the right solution, it may not be. So the other issue which we touched on, would you invest assets outside of super? Super does have the great tax advantages, but obviously you can't do things like negative gearing. So you can't buy a property and use any extra interest that you've paid to be deducted against other income. So there are some advantages in keeping assets outside of super. Certainly, if you're below the age of 65, it's difficult to access a lump sum if you needed it. So, if you wanted to pass money on to your children, you do have to wait until a certain age before you can access money. And then there are some benefits in estate planning outside of super. Now, they're relatively complicated, so I won't go into great detail on them. But, there are some ways that you can pass on assets to children and others, which are easier outside of super. The other point, which I haven't written down because it's an issue some people raise. The government does change the super regulations every so often. They tend to tinker with the rules. The Division 296 thing is one example of that. Keeping some assets outside of super sort of protects you against the government bringing in some rules which may not be that beneficial to you. So, while I encourage people to say, look, use super as a tax advantage savings vehicle, you do want to be cognizant of, all governments have a habit of tinkering with these systems when it suits them. So what should you do? What's the best things you can do for your when you're investing for your retirement? Make sure you've got some diversification. There is another article which I read this morning about a guy called Bill Bingen. Now, he's a US financial planner who did a lot of studies on, how can you maximize your returns without generating too much risk when you have to make a drawdown in all sorts of market circumstances. And I'll try and summarize some of that detail that he's produced. He basically says you can typically draw down up to about 4.8% per annum without having too much risk on your retirement, not lasting as long as it should. He does say you should, diversify into fixed interest and property assets from equities, and also diversify within equities. You should have some small cap exposure. You should have some international exposure. You should be probably in some private equity exposures. And the more you can diversify, the more you can generate a higher return without increasing your risk too much. You do need to have risk assets in there just so you can beat inflation. What the InvestSMART mantra has always been: make sure you watch your fees and costs. You can't control the outcomes from your investments. It is what it is. The markets will move, but you can control how much you spend, what it costs you, and what fees you have to pay to get those outcomes. And we do stress that you should try and minimize those fees and costs wherever you can, because that will make a difference. If you've got a 7% return in your super fund and you're paying 1 to 1.5% in fees, that's a fair difference than if you're only paying, say, 0.5% in fees, in terms of how much you can spend and how much it will grow. On a other note, just things you should think about before you retire, before you stop working. As I found out, it's very difficult to borrow money when you've retired. Once your regular income stops, most lenders, banks, will not look at your retirement income as a source of income that you can repay debt with. They'll look at that, well, that's just to pay for your lifestyle. So if you can set up debt facilities, I set up one on my house just as what I look at it as is a sort of emergency fund. If I decide, going back to this sequencing risk, if I decide I don't really want to draw money out of my super fund because markets have fallen, I can borrow money against my house and use that to spend and wait for markets to actually recover. So, it gives me the flexibility to adjust where I get my income source from.
I've done the same thing, Alastair.
Yeah, and it's interesting. Credit cards are the same, Alan. Once you're over the age of 65, it's very difficult to get a credit card. So keep the ones you've got. And then my last point, Alan, just enjoy your retirement. We are in this country. I think we're blessed with a system where our standard of living is very good. We've got plenty of time, and just do the things you want to do when you retire, and don't worry about money too much.
What a good idea. That's excellent. Excellent advice. Excellent advice. So are there any, so is that it? Are we going to questions now? Are there any questions?
I wasn't sure if there were any. I don't know. I think Mitchell might have been answering them along the way, but I didn't see any that were.
Here's one from Josh. How far out from retirement do you recommend starting to shift from growth to balanced and then defensive assets?
Yeah, that's again is where market timing comes in, Josh. They do say that my children, who are the age of 35 and 33, I said they're in high growth assets, and I said you want to stay in that until you're at least 55, 60. I think it's when your income sources start to change, you should start looking at shifting. So in other words, if you're moving from full-time to part-time, you want to be moving away from 100% growth assets. Probably the age of 60, you want to be in 70 growth, 30% defensive. And as you get closer to 65, you want to be moving to more of a 60-40, 50-50. But as I mentioned, I will touch on that earlier because there's some interesting statistics or financial analysis that says you can actually start with defensive assets and move more into growth assets as you get older, which is an interesting way to look at it because you've got less time.
Mattia Tabachi says, in terms of setting up a debt before retirement, is it better to have an investment property with a mortgage, rent it out, or sell it prior to retirement?
Well, I think that comes down to negative gearing, Mattia. I mean, it's more, if it's negatively geared, you want to be probably sorting it out before you retire because you're deducting the interest against your earned income. Yeah. So you got to look at that. Yeah.
And the problem with negative gearing is you actually are incurring a loss. What you're deducting is a loss, and you have to incur the loss before you get deducted. So firstly, you've got to have income to deduct it against, and secondly, you've got to be able to fund the loss in the meantime. And so if you're in retirement, any property investments you've got really should be positively geared. But if you've if you've got a positively geared investment property, that's fine. Keep it going.
Keep it going. Exactly. Yeah. It's a good source of income. Yeah.
Exactly.
And typically, Ellen, that will be inflation, adjusting. The rent will go up with inflation. So it's actually quite a good.
Right. Yeah. No, it's good. It's good. Just bearing in mind that the rent is taxable. Well, it's fully taxable, whereas other things may not be.
Yeah.
Des Egan says credit cards are great for cash flow management, but banks are loath to issue credit cards to retirees regardless of income. Yeah, fair enough.
Yeah, no, that's true. Yeah.
Just hang on, but just hang on to the ones you've got is what Alice is saying.
Yes.
I mean, are the banks? I haven't encountered this yet, but are the banks likely to take a credit card off you when you retire?
Well, one card issuer, I won't tell you which one it was, put the fees up when I retired. Well, after I got over 65. And I rang them and said, why are you putting the fees up? Well, you're over a certain age. So I think they were actively encouraging me to cancel the card.
Come on, tell us who it is.
No, I can't do that. No. I'm supposing that they were being ageist. I think they would deny it, of course, but
they're rat bags. We should out them.
We should out them, exactly. But
Mark McAllister says, regarding setting up a debt facility pre-retirement, could this be simply an existing home loan redraw facility? The answer is yes, Mark. It can be.
Yes, which is what I've got. Yeah.
Yeah, I've taken a mortgage and I've got all the money sitting in an offset account.
Yep.
Emmanuel says, why get to debt in retirement? I don't think we are saying get to debt in retirement, are we?
No. What we're saying is, use your, rather than what we're really saying use your house as an asset to borrow money short term, but we're going to say you want to try and pay that off because it's not deductible. I mean, Manuel's right. You don't really want to be incurring huge debts when you've retired.
No. Pension phase. Wendell Raven says pension phase of super has a minimum drawdown amount you must withdraw. If you don't spend all of that, is there a way to return it to your super after the financial year?
I think yes. If you keep, and I'll caution that I'm not a tax expert, and I would recommend that you get tax advice on this one. My understanding is that if you take money out in a pension phase, so if you have your super fund with a pension phase and an accumulation phase, you take it out in the pension phase, you can recontribute if you still have a portion in accumulation.
Right. Good.
Yep.
Julie Speechley says, if you have excess cash, would you make non-concession contributions or invest in the market outside super?
That's where I touched upon this, whether you want to keep some money outside of your superannuation, depending on how old you are, Julie. If you put money in, at this age, so like take my children as an example, they've both got properties. They do have a little bit of surplus cash. At the age of 35, my advice to them has been, don't necessarily put it all into super because you won't get it out until you're 65. If you've got some excess cash, pay down some of their mortgage. Now, they've both got mortgages. If they didn't have a mortgage, it's probably a slightly different, recommendation. I would probably tell them, I would put probably half of it into super. If you could do it as a concessional contribution, obviously it's more tax advantage to you, but as a non-concessional contribution, it's a very tax effective place to save money, as long as you don't need it until you're 65.
Yeah, that's good. Sally Apocus says, is there other advice for what we can't access after 65 years of age, like a credit card, which is news for me at 62? Well,
Sally, I'd have a look through I've done about 4, I think it's 4, maybe 5 diaries of a self-funded retiree. And I started one of these before I haven't retired yet. As Ella knows, I'm still doing these webinars with them. But things I have thought about to get ready for retirement. There's a couple of things in there. The credit card and debt facilities is one. There was another one, which I can't quite remember. But if you have a look through those, there's a couple of other items, I think, which I mentioned.
Yeah. I can't think of anything else. And in fact,
No.
the thing to do is to just hang on to the credit card you got.
Yeah. Yeah. Well, I think, and the other one I think I did recommend is just simplify all the bank accounts and things you've got. When I went through all my stuff and I discovered that I had about 4 different bank accounts, some of which had no money. One of them had a little bit of money in them. So it's worth doing a bit of financial housekeeping at some point and just take off the card. Make sure you've got at least 1 credit card, probably 2, and they don't charge you too much in fees. And then simplify all the other banking arrangements that you have.
Mitchell Datson has put a link, Sally, to the Alastair's issue 1 of Alastair's series of the Diary of a Self-Funded Retiree. So there you go.
Oh, there you go. Thanks, Mitch.
And Joe Sest says, are there any issues with having both an SMSF and an industry super fund?
No, in fact, Joe, there is an advantage in that. So I had both until about a year ago. The reason I kept I didn't have an industry fund. I had a Colonial First State public offer fund, and they gave me a very attractive life insurance product. The premiums I was paying was probably much cheaper than I could get anywhere else for a life insurance, TPD, total and permanent disability insurance product than I could buy myself. So it was worthwhile keeping them both. When I cancelled my life insurance policy about a year ago, I thought I might as well merge them all into one because it just simplifies my life.
Very good. Well, we seem to have run out of questions, Alastair, and as always, it's been a great webinar, very informative. Hang on. One more before we go from Bob C. Do you recommend WARP products? Pros and cons. WARP. Do you know what that is?
No, I don't. Oh, is that a wrap? Do you mean a wrap, Bob?
Oh, yeah. He probably does. Sorry,
wrap products are what is a wrap? A wrap's just a platform. It's a platform where you can keep all your assets, and it gives you a summary of all the things you've got. Now, the only problem with a wrap platform is you've got to pay for that. It's just an easy way to see all the assets you've got. I'll do a wee plug for InvestSMART. We have a platform where you can put all your assets on there and see them all, and we don't charge you anything for seeing all your assets in the one place. So look, there's a whole lot of platforms. Some people use wrap platforms because their advisors recommend it. It makes life simpler for the advisor to look after things and to see what's there. As again, I think it goes back to fees and costs. Make sure you're not paying very much for it because it's really just a bit of accounting software that tells you what you've got.
Very good. Well, that's it. Thank you very much, Alastair. What a good thing.
Thank you, Alan. Cheers.
Cheers. And thanks to everyone for being a part of this little webinar. It was great. Good questions from everyone. See you around.
Thanks.